Welcome to Session 6. Today we examine short-term liquidity. This session, Working Capital Management, focuses on strategies for effectively managing current assets and liabilities to ensure efficient operations and maintain adequate liquidity. It can be a difficult balance to find, as it is often a trade-off, but that is what we'll investigate today. Working capital is the difference between a company's current assets and current liabilities, representing the net investment in short-term assets. It's a measure of a company's short-term liquidity, indicating its ability to meet its short-term obligations. A company with a healthy level of working capital is better positioned to manage its day-to-day operations, take advantage of opportunities, and weather unexpected challenges. The formula for calculating net working capital is net working capital equals current assets minus current liabilities. Working capital is composed of various current assets and current liabilities. Current assets include cash, which is the most liquid asset, accounts receivable, which represent money owed to the company by its customers, and inventory, which represents the raw materials, work in process, and finished goods that the company holds for sale. Current liabilities include accounts payable, which represent money owed by the company to its suppliers, salaries payable, which represent wages owed to employees, and short-term debt, which represents loans and other obligations due within 1 year. Effectively managing accounts receivable is crucial for minimizing bad debts and maximizing cash flow. This involves setting clear credit policies, determining the terms and limits for extending credit to customers, implementing procedures for monitoring accounts receivable, tracking outstanding balances, and identifying overdue payments, and establishing collection procedures for collecting overdue payments, such as sending reminders, making phone calls, or initiating legal action. Organizations can also use the accounts receivable turnover ratio to review effectiveness. Managing inventory effectively involves balancing the need to have enough inventory on hand to meet customer demand with the need to minimize storage costs and obsolescence. This requires determining optimal inventory levels, taking into account factors such as lead times, demand variability, and storage costs. It also involves using inventory management techniques such as just-in-time JIT inventory management, which aims to minimize inventory levels by receiving materials only when they are needed for production. Organizations can also review the effectiveness by using the inventory turnover ratio. Effectively managing accounts payable involves optimizing cash flow by negotiating favorable payment terms with suppliers, taking advantage of early payment discounts, and maintaining good relationships with suppliers. Negotiating payment terms can extend the time available to pay suppliers, improving cash flow. Taking advantage of early payment discounts can reduce the cost of goods sold and improve profitability. And maintaining good relationships with suppliers can ensure a reliable supply of materials and favorable payment terms in the future. Finally, organizations can review effectiveness by using the accounts payable turnover ratio. That completes the introduction to this session. Thanks for your attention. Up next, in the workshop part of this session, we'll examine two key theoretical frameworks: cash conversion cycle and the economic order quantity EOQ model.